The Warren Buffett indicator is a market metric named after the famous investor Warren Buffett. It is a simple calculation of the total market capitalization of all publicly traded companies in the United States, divided by the country's gross domestic product, GDP. The idea behind the indicator is that when the market capitalization to GDP ratio is high, it may indicate that the stock market is overvalued. Conversely, when the ratio is low, it may indicate that the market is undervalued. However, it's important to note that the indicator is not a guarantee of future market performance, but rather, it provides a historical context for market valuation. Some investors and analysts consider it a rough guide for determining whether the stock market is overvalued or undervalued and use it as a factor in their investment decisions. However, this indicator should not be used in isolation and must be considered along with other market metrics and economic indicators. This will provide a more comprehensive understanding of market conditions and potential investment opportunities. The Warren Buffett indicator calculation is as follows. Market capitalization of all publicly traded companies in the US, gross domestic product, GDP, equals Warren Buffett indicator. For example, let's say the total market capitalization of all publicly traded companies in the US is $30 trillion and the GDP is $20 trillion, the Warren Buffett indicator would be $30 trillion per $20 trillion equals 1.5. A value of 1.5 would indicate that the market capitalization is 150% of the GDP. A value above 1 indicates that the market is overvalued, while a value below 1 suggests that the market is undervalued. However, the indicator should not be used in isolation and must be considered with other market metrics and economic indicators to make an informed investment decision. The Warren Buffett indicator is not a guarantee of future market performance, but rather a historical context for market valuation. A value below 1 suggests that the market may be undervalued, but this should not be the sole determining factor in investment decisions. Here are some other considerations. Economic fundamentals. A strong economy with low unemployment and steady growth can support stock market valuations. Company fundamentals. The financial health and growth potential of individual companies should also be evaluated. Interest rates. Low interest rates can be a positive for stocks, while rising interest rates can pressure stock prices. Market sentiment. Positive investor sentiment can drive stock prices higher, while negative sentiment can lead to sell-offs. Diversification. Diversifying investments across different asset classes and industries can reduce risk. In short, the Warren Buffett indicator can be used as one of the many metrics to consider when making investment decisions, but it should not be relied upon solely. It's important to do thorough research, consider multiple market indicators and economic factors, and consult with a financial advisor before making any investment decisions.